Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine a tech giant, a name so woven into the fabric of computing, it's practically synonymous with the digital age. For decades, it was the undisputed champion.
Absolutely. Intel inside, right? Everyone knew it.
Exactly. But now, picture that titan at a profound crossroads, locked in a high-stakes battle to reclaim its crown in the AI revolution. Nvidia, well, they're the reigning monarch of AI chips, casting a long, formidable shadow.
No question. They're the dominant force right now.
And AMD, the perennial challenger, is aggressively gaining ground. They're not sitting still.
Not at all. They've really turned things around.
And this legend, Intel, its bold new AI strategy isn't just a simple pivot, it's a monumental all-or-nothing gamble. Can this venerable company truly catch up, or will the missteps of its past finally derail an audacious comeback?
That's the billion-dollar question, isn't it?
Welcome. We're about to explore this in depth, specifically for you, the individual investor. We're sifting through the very latest insights, the most critical data, and Intel's most strategic moves.
Our goal today is really to cut through the noise.
Right. To give you a clear, data-driven guide to the Silicon Valley legend's future. We're here to extract crucial nuggets of knowledge, deliver some surprising facts perhaps, and offer the clarity you need to navigate this pivotal, fascinating moment.
Let's unlock what truly matters here.
So when a colossal ship like Intel needs to turn its tide, especially in a market as fast-moving as AI, who exactly is at the helm, and what's their audacious plan to make this monumental shift happen?
Okay, yeah, that's where the story of Intel's new leadership really begins, and it's pretty fascinating. At the very top, steering this ship since September 2024, is Lip-Bu Tan.
Lip-Bu Tan, okay.
Yeah, and he's not just another CEO. He's a seasoned tech visionary. His track record, frankly, screams turnaround specialist.
Really? Where was he before?
Before Intel, he was the driving force behind Cadence Design Systems. Now imagine taking a company from, let's say, a relatively modest market cap of $1.7 billion and just catapulting it to over $70 billion.
Oh, $70 billion.
$70 billion. That's not just growth. It's a masterclass in value creation, fundamentally reshaping an entire enterprise.
Yeah.
So his mandated Intel is incredibly clear, but also incredibly daunting. Revitalize the struggling foundry business.
The manufacturing side.
Exactly, making it a viable service for other companies, not just Intel. And at the same time, aggressively accelerate Intel's AI strategy to go head-to-head with Nvidia.
So a two-front war, essentially, foundry and AI.
Precisely. And one of his first truly bold moves, a decision that really sent ripples through the industry, was canceling the Falcon Shores GPU.
I remember that. That was a big project, wasn't it?
Huge. Deep in development, significant investment already sunk in. But instead of staying that course, he pivoted. Switched focus to something called Jaguar Shores, slated for 2026.
Jaguar Shores, what's different about that?
It's not just another chip. It's conceived as a rack-scale AI solution. Think entire data center racks optimized for AI workloads, all integrated.
Okay, so moving beyond just selling the individual processors.
Exactly. This shift signifies a profound move away from just component-level innovation, selling individual chips, towards focusing on comprehensive system-level solutions. It's like shifting from selling car engines to designing and selling entire, fully integrated high-performance vehicles.
That's a fundamentally different business model, really.
It absolutely is. A different beast to manage, requiring different expertise, different sales motions, everything.
That's a powerful shift in strategy, moving from components to full systems. But you don't pilot a ship this big alone, right? Who else is part of this command team, especially thinking about areas like the consumer market, the PC side, and the all-important software piece?
You're absolutely right. It's definitely a multi-talented leadership team they've assembled. You've got Michelle Johnston-Holthaus, who serves as co-CEO and heads up Intel's client computing group.
Okay, so she's focused on PCs and laptops.
Exactly. Her focus is squarely on the AI PC initiative, which is just a massive, incredibly ambitious push. They're targeting a staggering 100 million AI PC shipments by 2026.
100 million. That's a huge volume.
It's enormous. And this isn't just some marketing slogan. It's a concrete goal that will define a significant chunk of Intel's future revenue and market relevance. Holthaus brings over 25 years of deep Intel experience to this role. She spearheaded the successful launch of the Core Ultra processor,
which is the chip powering these AI PCs, right?
That's the one, the foundational piece for these new AI-capable laptops. She's essentially tasked with putting AI directly into the hands of millions and millions of consumers.
Okay, so that covers the client side. What about the pure AI horsepower, the software that makes it all work?
Right, for the core AI technology itself, they brought in Sachin Gaudi. He was appointed in 2025 to lead Intel's dedicated AI group.
Gaudi, what's his background?
He's a former Stanford professor, deep background in networking and AI. His critical task, and it's nothing short of monumental, is to enhance Intel's software ecosystem.
The software. Always the challenge.
Always. And this is absolutely crucial because it's where Intel directly challenges NVIDIA's highly entrenched CUD platform. CUD isn't just software, it's an entire universe, right? Developer tools, libraries, frameworks. It's built a massive competitive moat for NVIDIA over years.
So Gaudi's job is basically to build Intel's counter-universe.
Essentially, yes. To build Intel's own gravitational pull in the software space, making it easy and attractive for developers to build on Intel AI hardware. It's a huge undertaking.
And who's handling the big enterprise customers, the data centers?
That falls to Justin Hotard. He's the Executive Vice President and General Manager of the Data Center and AI Group. He's the champion for enterprise AI deployments.
So getting things like Gaudi 3 into big companies.
Precisely. Including those key partnerships with giants like IBM and Dell for the Gaudi 3 accelerator. His prior experience at HPE is particularly valuable here.
Why HPE?
Because it equipped him with the unique insights needed to navigate the notoriously complex worlds of large enterprise ecosystems. These aren't simple sales. They involve deep relationships, understanding complex IT infrastructures, long sales cycles. It's a different game.
Makes sense.
So collectively, these leaders, Tan, Holthaus, Gaudi, Hotard, they're orchestrating a profound transformation. They're reshaping Intel into a multi-architecture powerhouse, meticulously balancing their core CPU business, which is still huge,
The bread and butter.
with aggressive new pushes into GPUs and specialized AI accelerators like Gaudi. Their overarching philosophy seems to be a strong focus on open systems, trying to move away from proprietary lock-in and critically cost efficiency.
Taking aim at NVIDIA's model there, perhaps.
You would certainly see it that way. It directly challenges the often proprietary high-cost solutions offered by some competitors. It's a fundamental shift in how Intel operates and how it intends to compete going forward.
So we have this powerful lineup of new talent with an ambitious plan. But assembling a dream team is one thing. Changing the very DNA of a company like Intel, especially one rooted so deeply in its past, that's another challenge entirely. How profoundly is this new leadership actually reshaping Intel's core identity and its very foundation?
That's a brilliant question because we are looking at a very different Intel than the one founded back in 1968 by legends like Gordon Moore and Robert Noyce.
The pioneers?
Absolutely.
Yeah.
But it's no longer a founder-led company or even family-operated in any sense. While Moore's Law, that famous prediction about transistors doubling roughly every 2 years, well, that remains a deep cultural cornerstone, something that guides their ambition.
It's part of the mythos.
It is. But the day-to-day decision-making rests firmly with professional management now. Lip-Bu Tan's track record at Cadence, as we discussed, suggests he could be an exceptional leader for this new era. But, and this is the big but, his ability to execute Intel's incredibly ambitious AI and Foundry goals is still unproven at Intel. His impact is a critical variable for any investor right now.
So it's still a bet on his leadership, really.
It's absolutely a calculated gamble on his leadership clicking within the Intel structure and market dynamics.
And how are they incentivizing this new team? Is their pay tied to hitting these massive goals?
Yes, and that's crucial. When we look at leadership incentives, Intel has structured its executive compensation to align pretty closely with shareholder interests, or at least that's the goal. It's a mix.
Yeah.
Base salary, performance bonuses, and equity awards.
Standard stuff, mostly.
The structure is standard, but the focus is key. For instance, Lip-Bu Tan's package includes a base salary of $1.2 million. Okay, that's significant. But his real incentives come from bonuses tied directly to metrics like revenue growth, the profitability of that critical foundry business, and, importantly, gains in AI market share.
So hitting the AI targets directly impacts his bonus.
Directly. Plus, he gets restricted stock units, RSUs, that vest over 3 years. That really ties him financially to the long-term success or failure of the company.
How does that compare to, say, the previous CEO or competitors?
Good question. To put it in perspective, their former CEO, Pat Gelsinger, received $17.5 million in total compensation in 2023, and about $10.5 million of that was in equity. So there's a clear precedent for heavily rewarding long-term value creation through stock.
And compared to Nvidia or AMD?
Well, the numbers are bigger there, reflecting their recent performance. AMD's Lisa Su earned $30.2 million in 2023, and Nvidia's Jensen Huang brought in $34.2 million.
Wow.
Yeah, big numbers. But what's important here is the structure. Intel seems to rely perhaps even more heavily on equity for retention compared to some peers. This makes sense when you're trying to keep top talent motivated during a challenging turnaround period with significant financial pressures.
Locking them in with stock.
Essentially. And while overall insider ownership is low under 1%, the performance metrics tied directly to executive pay are designed to ensure that leadership is rowing in the same direction as shareholders.
Okay, and what about the broader company mission and culture under this new leadership? Has that shifted?
Intel's official mission statement remains grand: to create world-changing technology that enriches the lives of every person on Earth. Their vision emphasizes establishing a predictable cadence of leadership products across critical areas like AI, 5G, and edge computing, all within that framework of open ecosystems we talked about.
So the words are still ambitious.
Very. And under Tan, there's definitely a strong push to foster a culture of execution and customer centricity, words you hear a lot. However, we absolutely cannot ignore the recent realities. 15,000 layoffs.
That's a huge number.
It's massive.
Yeah.
And widespread cost-cutting measures. These have undoubtedly created significant cultural challenges and potentially impacted morale and employee trust. Imagine the stress and uncertainty for the remaining workforce.
Yeah, that has to take a toll.
It does. But despite these tough measures, the company maintains these audacious goals to lead in enterprise AI, become a top-tier foundry player. They're pushing hard through initiatives like the Intel Tiber software portfolio and that massive AI PC push. It's a real high-wire act, trying to balance those harsh operational realities with soaring, almost necessary ambitions.
So on one hand, we have a clear, ambitious vision, maybe even a necessary one. But on the other, a relatively new leadership team, at least working together, playing catch-up against established industry titans like Nvidia. Is there a real scenario where this untested synergy you mentioned completely derails their plans? Or are the risks maybe a bit overblown?
No, I don't think the risks are overblown at all. They are substantial and multifaceted. First, there's the immediate concern around leadership stability and succession planning. Pat Gelsinger's abrupt exit in December 2024, followed by Tan's very recent appointment. Well, that naturally raises questions about long-term consistency right at the very...
It creates uncertainty.
Absolutely. And there's an inherent risk of over-reliance on Lip-Tan's singular vision. If persistent software issues, or frankly execution problems, continue to plague their AI efforts, as we saw with the underperformance of Gaudi 3 missing its targets, then his vision, no matter how brilliant on paper, could falter in practice.
Like having a great playbook but fumbling the execution.
Exactly. It's like having a championship coach, but if the team can't actually execute the plays effectively on the field, the game is still lost. On top of that, those cultural tensions we mentioned, stemming from the significant layoffs and ongoing cost-cutting, that could very well hinder the kind of rapid, agile innovation Intel desperately needs right now.
A demoralized team doesn't innovate quickly.
Generally not. It can slow down even the best strategies.
And how does this stack up when you look directly at their competitors' leadership?
Well, when we compare them to their peers, the contrast becomes even sharper, frankly. Nvidia's Jensen Huang isn't just a CEO. He's practically synonymous with the AI revolution.
Yeah.
He has a proven, battle-tested track record, driving that astonishing $128.6 billion in revenue in 2024. He built an AI empire.
Check out the momentum.
He absolutely does. And similarly, AMD's Lisa Su has successfully orchestrated a remarkable revitalization of AMD's CPU and GPU businesses, achieving very respectable 15% revenue growth recently. She turned that ship around.
So proven turnaround artists versus a newer team at Intel.
Right. While Tan brings invaluable foundry expertise from Cadence, and Kadi's deep AI focus is definitely promising, their synergy as a new leadership team at Intel, facing these specific challenges, is still untested. They're fundamentally playing catch-up against established, highly successful leadership that has already delivered immense value in the very areas Intel is now pushing hardest into.
It's not just about having great individuals then.
No, it's about how quickly they can gel, build trust across the organization, and execute flawlessly against formidable, proven competition. This isn't just a race. It's more like a marathon, where their key competitors got a significant head start and are still running incredibly fast.
This truly is where it gets interesting for investors. We've talked about the leadership, the vision, but how does this company, this titan, actually make its money day in, day out, and What makes its approach unique in such a fiercely competitive landscape? Let's really talk about the engine under the hood.
Okay, yeah, let's get into the business model. At its core, Intel's model is, conceptually, quite understandable. They design and manufacture semiconductors. Simple enough on the surface.
The chips.
The chips. The CPUs, the GPUs, and now these specialized AI accelerators that power literally everything from your personal computer to massive cloud data centers and, increasingly, devices out at the edge, like in cars or factories.
But what makes them different? Lots of companies design chips.
Right. What sets them apart, their fundamental historical differentiator, is their integrated device manufacturing model, the IDM model.
IDM, okay.
Think of it like a truly exceptional farm-to-table restaurant.
Right.
They don't just design the menu, the chip blueprints. They actually grow the ingredients, manufacture the silicon wafers. They prepare the food and fabricate the chips, and they sell the final product. They control or aim to control both the design and the foundry operations where those chips are physically made.
Controlling the whole process.
Exactly. Now, the complexity and where the absolutely massive capital investment comes in is in those colossal foundry operations, the factories. And critically, especially now, in developing a robust AI software ecosystem to make their hardware useful.
So the farm and the kitchen are incredibly expensive.
Incredibly. Now, let's look at their product portfolio. It's truly immense and diverse. When we talk CPUs, the central processing units, they have the Xeon processors. These are the workhorses, the backbone for servers, the kind of chips powering the internet, cloud computing, enterprise data centers globally.
Still a huge market for them.
Massive. And they're still innovating there. Think about the new Xeon 6, which delivers something like 2.4 times better performance per watt compared to previous generations. That's a huge leap in efficiency, especially for energy-hungry data centers where electricity costs are a major factor.
Okay, that's servers. What about PCs?
Then you have the core processors for PCs and laptops. This includes the new Core Ultra line, which is specifically designed for these AI PCs we mentioned, bringing powerful AI capabilities directly onto your laptop for tasks like real-time translation or enhanced content creation.
Trying to create a new PC upgrade cycle.
That's certainly part of the strategy. Now, in the dedicated AI accelerator space, their big bet right now is the Gaudi 3 chip, which launched commercially in the third quarter of 2024.
Gaudi 3. This is their competitor to Nvidia's big AI chips.
Exactly. And here's where it gets really fascinating from a competitive standpoint. Gaudi 3 boasts, according to Intel's numbers, 50% better inference performance.
Inference speed.
How quickly an AI model can use its training to make predictions or decisions in the real world. Faster inference means quicker results. And crucially, 40% better power efficiency than NVIDIA's H100 chip, which was the gold standard.
Better performance, less power? Sounds great.
What's the catch? Well, the other big headline is the price. Intel is pricing Gaudi 3 significantly lower, around $15,625, compared to roughly $30,678 for an NVIDIA H100. That's nearly half the price.
Half price, better efficiency, better inference. Why isn't it everywhere?
That's the critical question. While it has seen adoption by key players like IBM and Bosch, it significantly missed its $500 million sales target for 2024.
Missed it by how much?
They shipped around 200,000 units versus a plan for 300,000. And the primary reason cited, software immaturity.
The software again.
It's the recurring theme. This isn't just a technical hiccup. It's a stark, undeniable truth in the AI race. Superior hardware specs are only half the battle. Intel's Gaudi 3, despite its impressive potential on paper, hit a wall because its software ecosystem, the tools needed for developers to easily use it, just couldn't keep pace with the hardware launch.
So it's like having a Ferrari engine, but only bicycle tires available.
That's a perfect analogy.
Yeah.
The raw power is there, but without the right software foundation, the tires, the transmission, the steering, it just can't perform as intended or be easily adopted by the broader market.
Okay, so Gaudi 3 is a work in progress on the software side. What else is in the portfolio?
Then we have the AI PCs, powered by those Core Ultra processors. We talked about the massive shipment goals, 40 million in 2024, aiming for 100 million by 2026. This is a huge volume play, betting heavily on AI becoming a standard feature on personal devices.
Bringing AI to the masses.
That's the idea. And to help enterprises actually use their AI hardware like Gaudi more effectively, they launched the Intel Tiber portfolio, also in Q3 2024. This is a suite of software and services designed to streamline AI deployment, making it easier for businesses to get AI projects up and running on Intel silicon.
Trying to address that software gap directly.
Directly. And of course, underpinning a lot of the future strategy are their Foundry services. They're now actively manufacturing chips for external clients, most notably Microsoft, utilizing their advanced 18A process node.
18A being their cutting-edge manufacturing tech.
Exactly. One of the most sophisticated manufacturing processes available anywhere. And looking ahead, their roadmap includes Jaguar Shores in 2026, that rack-scale AI solution, and also Panther Lake processors coming sooner in 2025, aimed at mobile AI, so next-gen laptops and potentially other devices. It shows a clear, albeit ambitious, forward trajectory.
The farm-to-table analogy for their IDM model really helps clarify that integration controlling everything from the ground up. But that sounds incredibly capital-intensive, just pouring money into factories. Does that vertical integration sometimes become a burden, especially when competitors like Nvidia can just outsource the heavy manufacturing lifting to foundries like TSMC?
You've hit on the absolute core tension of the IDM model. It is incredibly capital-intensive, requiring billions upon billions in ongoing investment. And yes, absolutely, it can be a burden, especially during downturns or when technology transitions are complex.
Please down the balance sheet.
Significantly. But it's also their defining characteristic, their potential secret sauce, that seamless blending, or the attempt at seamless blending, of chip design and state-of-the-art manufacturing under one very large roof. This fundamentally distinguishes them from purely fabless competitors like Nvidia and AMD, who rely entirely on external foundries, predominantly TSMC.
So it's both a potential strength and a potential weakness.
Precisely. Intel's deep-seated passion for world-changing technology isn't just marketing fluff from their mission statement. It's intricately woven into their economic engine, which historically focused on high-margin chips enabled by their manufacturing prowess. Now, the potential is to leverage this integration to lead in areas like open AI systems.
Open systems. How does IDM help there?
The idea is that by controlling manufacturing, they can optimize hardware for specific open standards, perhaps more effectively than relying on a generic foundry process. This open systems approach is a deliberate counter-strategy. They aim to avoid the kind of vendor lock-in that customers sometimes experience with highly proprietary solutions. That's a significant potential advantage for large enterprises that often find themselves tied to a single vendor's ecosystem and pricing power.
So they're positioning themselves as the flexible alternative.
That's a key part of the pitch.
Yeah.
Their partnerships with major players like Dell and IBM for Gaudi 3 deployments perfectly exemplify this commitment to an open ecosystem, aiming to give customers more choice and flexibility in how they build their AI infrastructure.
Okay, that makes sense. And what about their track record? They've been around forever.
It's a truly storied one, stretching back decades. We're talking about historical milestones that literally shaped the modern world. The 8086 processor from 1978 that powered the very first IBM PCs, essentially laying the groundwork for the entire personal computer revolution.
Ancient history, but foundational.
Absolutely foundational. Then there's the enduring dominance of their Xeon line in the server market for decades, which really powered the internet's explosive growth and the rise of cloud computing. They've also shown a remarkable ability at times to execute strategic pivots. Acquiring Habana Labs back in 2019 for $2 billion was a key move to bolster their AI expertise and bring in the technology that evolved into Gaudi.
So they have adapted before.
They have. Now, their revenue did peak at $79 billion back in 2021. It dipped significantly to $63.1 billion in 2023, largely due to that broader PC market decline, a market known for its cyclical boom and bust nature. But we're already seeing signs of a partial recovery, tracking towards an annualized $54.2 billion based on Q3 2024 numbers. So this history shows a company capable of massive innovation and adaptation, even if the current turnaround journey is perhaps the most fraught with challenges they've ever faced, requiring a massive reinvestment phase.
It's clear they have the history, the scale, and the strategy, but from a practical standpoint, day to day, how do they actually do what they do? From those sprawling multi-billion-dollar factories to getting the finished chips into customers' hands, it sounds like a logistical marvel, or maybe a nightmare, on a global scale.
It absolutely is a logistical marvel involving immense scale, mind-boggling complexity, and precision timing, operating across multiple continents simultaneously. Intel's headquarters, the Brain Trust, is in Santa Clara, California, right in the heart of Silicon Valley. But their operational footprint, the manufacturing muscle, is truly global.
Where are their main factories?
They own and operate massive manufacturing facilities, or fabs as they're called, in key locations. Arizona and Oregon in the US, Ireland in Europe, and Israel in the Middle East. Their assembly and testing operations, the final stages, are heavily concentrated in Asia, specifically Malaysia, Vietnam, and China.
So still a significant reliance on Asia for parts of the process.
Yes. And while they emphasize their integrated IDM model, it's important to note they aren't completely dogmatic about it. They do outsource some specific manufacturing processes, notably leveraging TSMC for Gaudi 3's 5-nanometer production node.
Interesting. So even Intel uses TSMC sometimes.
It shows a pragmatic approach, right? Leveraging external expertise or capacity when it makes sense, rather than insisting on doing absolutely everything 100% in-house, especially when speed or specific technology access is critical.
And those huge investments in new U.S. factories.
Right, their commitment to onshore or friendshore manufacturing, particularly in the U.S., is underscored by truly staggering investments. They've poured $20 billion, that's billion with a B, into new foundry projects in Ohio and Arizona.
20 billion. It's hard to even conceptualize that number.
It is. And to put it into perspective, these aren't just buildings. We're talking about cutting-edge fabrication plants the size of small cities, packed with the most advanced, complex, and expensive machinery on the planet. This level of investment is intended to fundamentally reshape the semiconductor manufacturing landscape in the U.S. over the coming years.
So that high degree of vertical integration, controlling design and fabrication, it allows for quality control, but the cost must be immense.
It allows for potentially immense quality control and optimization, yes, but it comes at a very steep price, demanding incredibly heavy capital expenditure, or CapEx. They spent a whopping $25 billion on CapEx in 2023 alone.
$25 billion in 1 year.
It's astronomical. And this is a stark contrast to Nvidia's completely fabulous model, which relies entirely on partners like TSMC for all manufacturing, freeing up Nvidia's capital for R&D and software. Intel's strategy, especially with this massive foundry expansion, is a long-term bet, leveraging its immense scale to eventually achieve unparalleled efficiency and cost advantages, not just for its own chips, but potentially for external foundry customers too, like Microsoft, or maybe even Nvidia themselves someday.
Manufacturing for their rivals, that would be something.
It's part of the vision for Intel Foundry Services. Now, their distribution model, getting chips to customers, is also multifaceted. They primarily sell through original equipment manufacturers, the OEMs.
Like Dell, HP, Lenovo.
Exactly. Dell, HP, Lenovo, Acer, Asus. The companies that build the actual laptops, desktops, and servers. Those OEMs then build Intel chips into their finished products. Intel also engages in direct enterprise sales for their largest data center clients, think cloud providers or big corporations. And they work through a vast network of channel partners and distributors to reach smaller businesses at specific market segments.
So multiple routes to market.
Yes. Their AI PC strategy, for example, is leveraging over 230 different OEM designs globally. That greatly enhances their market reach and scalability for that initiative. Similarly, their Gaudi 3 systems are primarily sold through key partners like Dell and Supermicro, who are experienced in building and selling complex server systems, ensuring broader deployment and integration into existing enterprise IT infrastructures.
And how predictable is their revenue, given all these moving parts?
I'd say it's moderately predictable. On one hand, about 60% of their revenue comes from recurring enterprise and cloud contracts, particularly with the big hyperscalers like AWS, Microsoft Azure, and Google Cloud. These tend to be longer-term agreements, providing a solid baseline of stability and a somewhat predictable stream of income.
That sounds good for stability.
It is. However, the client revenue side, which includes all those PC chip sales, is directly impacted by the inherent volatility of the personal computer market. That market can fluctuate quite significantly based on consumer demand, economic cycles, new product launches, you name it.
So the PC market swings can really affect their numbers.
Definitely. This creates a sort of push-pull effect on their overall revenue predictability. The enterprise side provides a foundation, but the consumer PC side introduces significant variability quarter to quarter.
It sounds like an incredibly complex and ambitious operation, juggling manufacturing, design, diverse markets. But no matter how grand the plan, every giant faces potential storms. What are the real thunderclouds on the horizon for Intel? Where are the serious threats lurking that could disrupt this intricate dance?
Oh, the thunderclouds are definitely numerous, and they come from several different directions, creating a highly dynamic and, frankly, perilous environment for them. Technologically, the competition in AI is just ferocious. It's relentless.
Nvidia and AMD aren't slowing down.
Not for a second. Nvidia's latest Blackwell B200 platform and AMD's MI300X accelerators already appear to outpace Intel's current offerings, particularly in AI training capabilities, teaching the AI models. This isn't a small performance gap. It's a significant technical challenge to their market share aspirations. and puts immense pressure on Intel to not just catch up, but somehow leapfrog the competition, which is incredibly hard to do.
So they're behind in the highest-end AI race right now.
In many key benchmarks, particularly for training large models, yes. Then there are the regulatory threats, which seem to be growing in potency all the time. The ongoing U.S.-China trade restrictions are a major, major concern for Intel.
Oh, specifically for Intel.
Because a huge chunk of their revenue, about 27%, currently comes from China. Any further tightening of export controls or import restrictions related to advanced semiconductors could severely disrupt their supply chains and significantly impact a substantial portion of their top-line revenue.
Almost a third of their business is exposed there.
It's a significant exposure, and this leads directly into the broader geopolitical risks, particularly the ongoing tensions in Asia, specifically around Taiwan and China, where not only Intel, but the entire semiconductor industry has significant manufacturing dependencies, either directly or through partners like TSMC. Any major escalation or disruption in that region could have profound, potentially catastrophic implications for global semiconductor production.
A supply chain nightmare scenario.
It's the scenario that keeps supply chain managers up at night across the industry. Now, Intel does possess a degree of resilience, of course. This resilience has been forged over decades of competing in a brutally tough industry. Their diversified portfolio spanning PCs, servers, networking, and now AI and Foundry does provide some buffer against downturns in any single segment. If PC sales dip, hopefully server sales hold strong, or vice versa.
Don't put all eggs in one basket.
Exactly. And we've seen them adapt successfully in the past. Think about their crucial shift to multi-core CPUs back in the early 2000s when single-core performance hit a wall. That showed genuine flexibility in responding to fundamental market shifts. However, their current software challenges, particularly in AI, and the sheer intensity of the AI competition definitely limit what you might call their anti-fragility right now.
Meaning they're less able to bounce back stronger from shocks.
Precisely. The slow adoption of Gaudi 3, for instance, despite its compelling hardware advantages on paper, is a clear, painful example of how critical software maturity is in this new AI landscape. It starkly shows where their resilience is currently weakest. They can probably weather an economic storm better than some, but a lack of robust, mature software infrastructure makes them particularly vulnerable to a direct competitive hit in the crucial AI space. They need that software shield, and it's not fully built yet.
Every great company needs an impenetrable fortress, right? A competitive advantage, a moat, as they say, that sets it apart and protects it. What's Intel's moat, and how solid is it really in this brave new world of AI where the rules seem to be rewritten almost daily?
That's the multi-billion-dollar question, isn't it? What is Intel's moat today? And the answer is, well, it's complicated. Intel certainly has some formidable fortifications, some deep moats, but they are unevenly distributed across their different business segments, and some parts look decidedly less secure than others.
Okay, break that down. Where are they strongest?
In the traditional server CPU market, they definitely exhibit monopolistic traits, still commanding over 70% market share. That's a dominant position.
Why is that moat so strong?
It's largely thanks to incredibly high switching costs for their big enterprise customers. These companies have optimized their software, their operating systems, their entire IT infrastructure around Intel's Xeon processors for literally decades. Migrating off that deeply entrenched platform is a monumental, expensive, and risky undertaking. It's akin to trying to rebuild a city's entire electrical grid while keeping the lights on. So that server CPU base is still quite secure.
Okay, that's a solid moat. What about AI?
Well, the picture is dramatically different in AI accelerators.
Yeah.
Their market share is currently tiny, estimated at under 5%.
Yeah.
This is absolutely dwarfed by Nvidia's colossal 80% plus share. This really highlights the immense challenge of trying to build a new fortress in a hostile territory that's already heavily defended by a powerful incumbent.
So the AI moat is more like a ditch right now.
It's barely been dug, let alone filled with water and crocodiles. Now, economies of scale are another potential huge advantage for Intel, stemming from that IDM model. Their massive $20 billion investments in new foundries, like those in Arizona and Ohio, are specifically designed to deliver unparalleled cost per unit advantages once they're running at full capacity.
Cheaper to make chips at massive volume.
Exactly. These cutting-edge fabs, set to produce their advanced 18A process chips by 2026, represent a scale of investment that smaller fabless competitors simply cannot match on their own. When you can produce chips at a fundamentally lower cost per unit, you gain significant leverage either to offer more competitive pricing to win share or to enjoy healthier profit margins. This is a foundational strength, leveraging their sheer size and manufacturing ambition.
What about network effects, like Nvidia has with CUD?
That's a critical point, and frankly, it's a weakness for Intel and AI right now. Their AI solutions currently lack strong network effects. This is primarily because their software ecosystem, as we keep saying, is still quite nascent. It hasn't reached critical mass.
Compare that to CUD.
All right. Contrast this sharply with NVIDIA's CUDA platform. CUDA thrives on a vast, deeply entrenched community of developers, researchers, and data scientists who have invested years learning and building on it. NVIDIA has meticulously built an entire universe around CD libraries, tools, frameworks, cloud support. This makes it incredibly sticky. Developers learn CDA, they invest time building CDA applications, and then they naturally choose NVIDIA hardware to run them. It's a powerful self-reinforcing cycle.
A virtuous cycle for Nvidia, a tough one for Intel to break into.
Exactly. Intel is trying to build a similar gravitational pull with its focus on open source initiatives like OneAPI and supporting standard frameworks like PyTorch. But it's a real uphill battle against years and years of ingrained developer loyalty and the sheer momentum of CDA.
How are they trying to counter Nvidia's position strategically?
Their counter-positioning strategy is actually quite interesting and potentially clever. Intel is explicitly pursuing an open systems approach. They're designing their hardware and software to work well with industry standards, like standard Ethernet for networking instead of proprietary interconnects, and popular open source frameworks like PyTorch and TensorFlow.
So, deliberately being the anti-lock-in option.
Precisely. This directly counters NVIDIA's more proprietary, vertically integrated strategy, particularly around its NVLink interconnect and CUDA platform. This open approach strongly appeals to large enterprises and cloud providers who desperately want more flexibility, more vendor choice, and want to avoid being beholden to a single supplier's roadmap and pricing. It's a smart strategic move, targeting a real pain point in the market. But its ultimate success hinges on whether enough big customers prioritize that openness over CUDA's current maturity and performance edge.
Okay, and switching costs. Still high for servers, but low for AI.
Generally, yes. Switching costs remain very high for their traditional server CPU customers. Businesses have invested years and millions optimizing their complex enterprise software and hardware stacks for Xeon. Migrating that is a massive headache. So that revenue stream, while maybe not growing rapidly, is relatively secure and provides crucial cash flow. But in the AI space, switching costs are much lower, especially for new projects. Companies are evaluating different accelerators based on performance, price, and software availability now. Intel doesn't have that decades-long lock-in advantage in AI.
What about their brand? Intel Inside was iconic. Does it help in AI?
The Intel brand, especially Intel Inside, is still incredibly powerful. It's synonymous with reliability, compatibility, and performance in the CPU world. It absolutely allows them to command premium pricing in PCs and servers and evokes a deep sense of trust built over decades. But in the AI space, that brand recognition is far less impactful today. NVIDIA has largely captured the perception, the mind share, as the leader in cutting-edge AI innovation. The public and even many enterprise buyers don't automatically associate Intel with leading AI performance yet. Their brand needs to catch up to their AI aspirations.
Do they have any unique resources nobody else has?
They certainly have cornered resources that are incredibly difficult, if not impossible, for others to replicate quickly. They hold a massive portfolio of over 18,000 patents, a treasure trove of intellectual property covering decades of semiconductor innovation. Their global foundry infrastructure, those multi-billion-dollar fabs, represent a colossal physical competitive edge, especially with the new investments coming online. Strategic acquisitions like Habana Labs brought in critical AI expertise and technology that they might have struggled to develop organically in time. And they've significantly bolstered their talent pool with key external hires like Sachin Kadi, strengthening their AI push with top-tier brainpower. These are tangible, defensible assets that provide a very solid foundation.
And the IDM model itself, does it give them an edge in refining manufacturing?
In theory, yes. Their IDM model, blending design and manufacturing, should allow for tighter integration, faster feedback loops, and more optimized manufacturing processes tailored specifically to their own chip designs. That's the promise. However, their historical execution hasn't always lived up to that promise. We've seen past execution gaps, like the delays with the Gaudi 2 launch or the more recent cancellation of the Falcon Shores GPU project after significant investment. These instances show that even with potentially superior processes on paper, operational missteps and strategic pivots can and do occur. The best laid plans only work if executed flawlessly. What about their actual chip tech, like Gaudi 3? Is it truly disruptive? Let's look at Gaudi 3's proprietary technology. Its raw compute power, measured at around 1.835 petaflops of FT8 compute. It's genuinely competitive.
Remind me what petaflops and FP8 mean again.
Sure. PFLOPS, or petaflops, refers to quadrillions of floating point operations per second. It's a measure of raw computational horsepower, critical for AI tasks. FP8 refers to using 8-bit floating point numbers for calculations. Using lower precision like FP8 is often much more efficient for AI inference making predictions, allowing you to process more data faster and with less power without losing too much accuracy for many tasks. So Gaudi 3 has serious efficient horsepower, but it's arguably not a revolutionary 10x improvement over Nvidia's H100, which was already on the market.
So good, but not a complete game changer.
Exactly. It's a strong offering, especially considering its compelling price point and power efficiency advantages, which are significant. But it doesn't represent the kind of order of magnitude leap that might instantly disrupt Nvidia's dominance. It's more of a solid, cost-effective competitor than a category killer, at least in its current form.
And timing. You mentioned they missed the boat earlier.
Timing, unfortunately, is where Intel truly missed a huge opportunity in the early days of the AI boom. Famously, and somewhat painfully in hindsight, they apparently declined the chance to acquire Nvidia way back in 2005 for what would now seem like pocket change.
Wow. Acquiring Nvidia in 2005.
It's perhaps the most expensive what-if in tech history. It's not just a historical footnote. It's a foundational strategic misstep that directly explains why Intel is in this challenging catch-up position in AI today. So while Gaudi 3's 2024 launch is timely in the sense that the AI market is still exploding, it faces deeply entrenched competition that has been building momentum, software ecosystems, and customer relationships for the better part of a decade. They're late to the party.
Which brings us back to execution speed.
Precisely. Their speed of execution has demonstrably lagged behind competitors at critical junctures. The software issues plaguing Gaudi 3's initial adoption, leading to those missed sales targets, and the strategic decision to cancel the Jaguar Shores project midstream. These are stark reminders that even with grand plans and significant resources, rapid, flawless execution is absolutely paramount in this incredibly fast-moving market. Any delay gives competitors more time to solidify their lead.
So, summing up the moat situation, strong in traditional areas but fragile elsewhere.
That's a good way to put it. When we look at the sustainability of their advantages, their traditional CPU moat, especially in servers, looks quite sustainable and robust due to those high switching costs. But their nascent AI moat is, frankly, quite fragile right now. Its future solidity is heavily reliant on them achieving dramatic improvements in their software ecosystem maturity and the successful, timely execution of future products like Jaguar Shores. New entrants, Nvidia's impending Blackwell platform, AMD's next-gen MI400, these could rapidly erode any AI gains Intel manages to make if their execution challenges persist. It's a very dynamic and precarious competitive landscape for their AI aspirations. The CPU business provides stability, but the AI future is far less certain.
So we've dissected their current strength, their vulnerabilities, their moats or lack thereof. But looking forward, how does this company actually plan to grow beyond its current state? What's the strategy, and what could realistically stand in its way as it charts its course for the long haul?
Intel's growth strategy is definitely aggressive and, importantly, multi-pronged. They're not just betting on one horse. They're trying to capture share across several key high-growth markets, almost like playing a strategic chess game across multiple boards simultaneously.
Okay, what are the main prongs of this strategy?
Firstly, there's market penetration. This is about selling more of their existing products into their existing markets. A key focus here is expanding Gaudi 3 sales, getting those accelerators into more data centers, particularly leveraging their extensive OEM network partners like Dell, Supermicro, HPE, to get those chips integrated into systems and out to customers.
Selling more Gaudi. Got it.
Secondly, market development. This involves pioneering or expanding into new market segments with their existing or slightly modified technology. The primary examples here are that burgeoning AI PC market, trying to create a whole new category, and also the rapidly expanding edge computing space.
Edge computing being
Things like smart factories, autonomous vehicles, retail analytics, situations where you need powerful, low-latency AI processing happening right where the data is generated, not back in a centralized cloud data center. Intel sees a big opportunity there.
Okay, penetration, development, what else?
Thirdly, product development. This is crucial. They have a clear roadmap, they say, for next-generation products designed to capture future growth. We mentioned Jaguar Shores, their big bet for rack-scale AI in 2026, designed to compete at the high end. And also Panther Lake processors coming sooner, in 2025, aimed specifically at mobile AI next-gen laptops, maybe tablets, potentially other form factors. This shows a commitment to a consistent pipeline of innovation, assuming they execute.
And the last prong?
Finally, and this is arguably becoming just as important as their own chip design, is diversification, specifically through growing their foundry services, IFS, Intel Foundry Services. This means manufacturing chips for other companies. The massive, potentially $40 billion contract with Microsoft to use Intel's 18A process is the flagship example here. This isn't just about selling chips, it's about turning Intel itself into a critical infrastructure provider for the entire semiconductor industry.
A very different role for them.
A fundamentally different role, leveraging their manufacturing scale and expertise as a service.
So where is the biggest growth potential among those strategies?
The overall growth potential is genuinely exciting on paper, particularly around those AI PCs, if they can truly ignite that market and those potentially huge foundry contracts. Imagine the scale if they land more deals like the Microsoft one. Potential strategic acquisitions could also further accelerate growth, perhaps bringing in key software talent or niche technologies.
But the risks are still there.
Oh, absolutely. The risks are ever-present and significant. Execution delays, as we've seen happen before, could easily derail product timelines and market momentum. And Nvidia's continued relentless dominance in the high-end AI training and inference market remains a formidable barrier. It's like trying to climb Everest while the current champion is already comfortably at the summit and still ascending.
What about the size of these markets they're targeting? Are they big enough?
Oh, the total addressable market, or TAM, for Intel across these areas is absolutely vast. We're not talking about niche markets here. They're playing in the core of the entire digital economy. Analysts estimate the market for AI chips alone is already around $50 billion and growing incredibly fast. The server CPU market, their traditional stronghold, is roughly $60 billion. The potential market for AI PCs is being estimated at a staggering $200 billion if it takes off as hoped. And the overall market for foundry services is projected to be well over $100 billion.
Huge numbers across the board.
Massive. So Intel's diversified strategy is a very deliberate attempt to capture a meaningful slice across all these booming segments. The goal is clearly to ensure they're not overly reliant on the fortunes of any single revenue stream, especially the potentially volatile PC market.
And their products serve many different industries.
Yes, their products serve incredibly broad applications. From the hyperscale cloud data centers run by Amazon, Google, Microsoft, down to individual personal computers, increasingly into sophisticated automotive systems, and across a huge variety of edge devices in manufacturing, healthcare, retail, smart cities, you name it. This inherent application diversity enhances their scalability. As industries undergo rapid digital transformation driven by AI, Intel aims to be a key enabler across the board.
What about supply chain risks? You mentioned geopolitics. Are they diversifying where they make things?
They are actively working on that. While they do still have a significant reliance on Asian manufacturing, particularly for assembly, test, and some outsourced components, representing about 27% of their capacity geographically, they're aggressively mitigating this risk through those massive multi-billion-dollar investments in new U.S. and European fabs, in Ireland and potentially Germany.
Bringing manufacturing closer to home.
Exactly. This strategic geographical diversification is absolutely crucial in today's volatile geopolitical climate. It aims to make their supply chain more robust, less vulnerable to regional disruptions, and aligns with government initiatives like the Chiche-Poussas Act in the U.S. and similar efforts in Europe.
And customer diversity. Are they too reliant on a few big buyers?
Their customer diversity is actually a significant strength. Intel serves the major cloud providers, AWS, Google, Azure, large global enterprises across all sectors, like IBM, Bosch, whom we mentioned, governments, and of course the massive global consumer market through PC sales via OEMs. This broad customer base reduces their dependency on any single segment, or even any single large customer. It provides a valuable buffer against market fluctuations. If enterprise spending slows, maybe cloud or consumer picks up, or vice versa.
Looking long-term, say over the next decade, how relevant will Intel likely be?
In terms of longevity, Intel's core products and strategic direction are deeply aligned with powerful, undeniable secular trends. Artificial intelligence, edge computing, 5G connectivity, the digitization of everything. These aren't short-term fads. They are fundamental technological shifts reshaping our world for decades to come. This strong alignment gives them, I'd estimate, a high probability, maybe around 80% of sustained relevance and participation in these markets over the next decade.
So likely still a major player in 10 years.
Very likely, yes. Their diversified portfolio is fundamentally designed to buffer them during market downturns and technological transitions. However, and this is the critical caveat, their level of success, whether they thrive as a leader or merely survive as a participant, hinges almost entirely on their AI execution in the near to medium term. That's the paramount factor determining their trajectory within that relevance.
So what are the absolute key drivers we should watch for growth?
The key drivers of their future growth are crystal clear. First, their AI accelerators, can Gaudi 3 gain traction, and can Jaguar Shores deliver? Second, their Foundry services. Can they land more big customers beyond Microsoft and execute reliably? And third, those AI PCs, will the market materialize at the scale they predict? Specifically, analysts project that Foundry revenue could grow by an impressive 20% annually for the next few years, which would be a significant tailwind for their overall financial health if achieved.
And the main risks to that growth story?
The main risks remain consistent. First, that intense AI competition from Nvidia and AMD, who are not standing still. Second, the potential for saturation or slower than expected growth in the core PC market, which still drives a lot of volume. And third, those ever-present geopolitical supply chain risks that could disrupt manufacturing, component sourcing, or market access, particularly concerning China and Taiwan.
Now, let's talk numbers, because at the end of the day, for individual investors trying to make a decision, that's what it often boils down to. What does the financial report card actually tell us right now, and what's the real value here when we look at the cold, hard data?
Okay, let's get down to brass tacks with the financials. Primarily looking at their recent performance, say, based on Q3 2024 earnings, which gives us a recent snapshot. The picture is, well, it reflects a company in deep transition.
How so? Start with revenue.
Revenue growth was actually negative, down 8% year over year, coming in at $13.3 billion for the quarter. This decline was primarily driven by continued weakness in the broader PC market, which faced its own inventory and demand headwinds during that period.
Okay, revenue down. What about profits?
Their profit margins also clearly reflect the challenges and the heavy investments. The operating margin stood at just 5%. That's a pretty significant drop from 10% back in 2022. A major contributing factor here has been the substantial operating losses incurred by their Foundry business segment.
The Foundry is losing money right now.
Yes, significantly. It requires absolutely massive upfront investment in fabs and R&D before it can achieve the scale needed to become profitable. It's like building a giant new factory. You spend enormous amounts of money for years before the first product rolls off the line and generates revenue, let alone profit. They are deep in that investment phase.
There's that rule of 40 metric often used for tech companies. Where does Intel stand?
Right. The rule of 40% is a quick heuristic, often used for software companies, but sometimes applied more broadly, to gauge a company's health by adding its revenue growth percentage to its profit margin percentage. Ideally, you want that sum to be above 40%. For Intel, based on those Q3 numbers, it scores a negative 3%. That's negative 8% growth plus 5% operating margin.
Yeah, negative 3%. That's not great.
No. For investors, this signals that the company is currently very much in a reinvestment phase, prioritizing future growth over current profitability and efficiency. It suggests that, for now at least, their product market fit in certain key growth areas, like AI accelerators and Foundry, isn't yet driving the kind of high-growth, high-profit combination the rule looks for.
What about return on invested capital? How effectively are they using all that money they're spending?
The return on invested capital, or ROIC, was only around 4% recently. This is notably below the typical semiconductor industry average, which tends to be closer to 10% or higher for leaders. This relatively low ROIC reflects both current operational inefficiencies and, again, the immense amount of capital being deployed for future growth initiatives, like those fabs, that haven't started generating significant returns yet. It means for every dollar they invest back into the business, they're currently getting a relatively low immediate return.
How's their balance sheet looking? Lots of debt from all this spending.
On the liquidity and debt front, their position seems moderate, actually. They reported a current ratio of around 1.5, which suggests they have reasonable liquidity to cover their short-term obligations. And their debt-to-equity ratio was around 0.4, indicating manageable leverage, which is pretty important given the sheer scale of their capital expenditures. They're not dangerously over-leveraged, even with the massive spending.
And cash flow. Are they generating cash or burning it?
Free cash flow growth has unfortunately been negative. They were burning cash, with free cash flow around negative $2 billion reported for 2024 up to that point, a sharp decline from generating positive $5 billion back in 2022. This swing is almost entirely attributable to that colossal $25 billion in capital expenditure we discussed. They are literally pouring money into the ground, into equipment to build that future manufacturing capacity. Cash is flowing out for investment right now.
Any specific operational metrics that stood out? You mentioned Gaudi sales.
Yes, that industry-specific metric on Gaudi AI accelerator sales really stands out. As we noted, they missed their internal $500 million target for 2024, shipping only about 200,000 units versus a planned 300,000. This isn't just a footnote, it's a crucial indicator of the real-world challenges they face in ramping up AI accelerator sales, competing effectively, and getting the software ecosystem mature enough for broad adoption. It shows the strategy hitting friction in the market.
How do these numbers look when you put Intel side by side with Nvidia and AMD?
Comparing Intel to its key peers really highlights the current stark reality of the competitive landscape. Intel's recent negative 8% revenue growth pales dramatically against Nvidia's astonishing 122% growth, fueled by the AI boom, and AMD's respectable 15% growth during similar periods.
A huge difference in growth trajectories.
Massive. And similarly, on profitability, Intel's 5% operating margin significantly trails AMD's 12% and is just dwarfed by Nvidia's colossal 50% plus operating margins, driven by their high-priced, high-demand AI GPUs. These stark comparisons really underscore the steep climb Intel has ahead, particularly in capturing profitable share in the AI segment. It's not just a small hill they need to climb, it's a veritable mountain range dominated by very successful incumbents.
What's the overall trend been like over the past few years?
Looking at the trends, both Intel's revenue and its profit margins have clearly been on a declining trajectory since their peak back in 2021, when they hit that $79.0 billion in revenue and a healthier 15% operating margin. However, the narrative Intel presents is that the aggressive cost-cutting measures implemented recently, combined with the strategic, albeit costly, investments in AI and Foundry, are precisely what could drive a significant recovery, potentially starting to show real results by 2026. The current financials undeniably reflect a company deep in transition, bearing the significant costs of its ambitious comeback strategy with the hope and investor expectation of substantial future rewards.
So after digesting all those numbers, the good, the bad, and the transitional, where does that leave us when it comes to deciding if Intel stock represents a golden opportunity right now, or maybe more of a flashing warning sign for us as investors? How do we value this?
This brings us squarely and crucially to valuation. And understanding why valuation matters so profoundly is key. Valuation isn't just some academic exercise for analysts. It's the process of determining if a stock's current price in the market is genuinely overvalued or undervalued relative to the company's true underlying potential and future prospects. This assessment directly guides your investment decisions. A low valuation relative to potential might signal a compelling entry point, while a high valuation suggests caution might be warranted, as the good news might already be priced in.
Okay, so how do we value Intel today? What are the methods telling us?
When we apply intrinsic valuation methods, which try to estimate a company's value based on its future cash flows, things like discounted cash flow or DCF models, current estimates for Intel's intrinsic value typically fall somewhere in the $30 to $35 per share range. Now, a big caveat. These models inherently rely on assumptions about the future.
And the key assumption here is?
The key assumption baked into that $30–$35 range is a fairly robust recovery in Intel's free cash flow generation, likely starting around 2026, as those massive Foundry investments hopefully start to pay off and contribute positively, and as AI revenues potentially ramp up, it assumes the turnaround plan works, basically.
Okay, that's intrinsic value. What about comparing it to its peers? Relative valuation.
Right, for relative valuation, we look at metrics like the price-to-earnings, PE ratio. Intel's PE ratio currently sits around 15 times earnings. This is notably significantly well below Nvidia's PE, which has been astronomically high, sometimes over 50x, and also well below AMD's PE, which is typically around 30x or more recently.
So compared to peers, Intel looks cheap on a PE basis.
On the surface, yes. That relatively low PE ratio suggests Intel might be undervalued compared to its direct competitors. Additionally, looking at its price-to-book, PB ratio, which compares the stock price to the company's net asset value, is currently around 1.2x. This generally indicates that its assets are being valued fairly or perhaps slightly conservatively by the market. It's not trading at a huge premium to its book value.
So valuation metrics seem to suggest potential undervaluation. But what's the actual investment thesis here? What are the bulls and bears saying?
Exactly. The valuation numbers provide context, but you need the narrative, the investment thesis. And there are strong arguments coming from both sides, the bears and the bulls. The bear thesis, often echoed by skeptical institutional investors and many online commentators, points directly and repeatedly to Intel's perceived AI execution failures. They hammer on Gaudi 3's missed sales targets and those persistent critical software ecosystem issues as clear, unaddressed weaknesses.
The show me the results argument.
Precisely. You'll see sentiment online, sometimes quite bluntly, describing Intel's AI strategy as confused or even a mess. This bearish view sees significant, perhaps insurmountable, hurdles ahead and seriously questions their ability to truly compete effectively against Nvidia and AMD in the high-stakes AI arena. They see a company potentially falling further behind.
Okay, that's the bear case. What about the bulls? What's their argument?
Conversely, the bull thesis, which is championed by some analysts like Stephen Dickens at the Futrim Group, for example, argues that Intel is fundamentally undervalued because the market is overly focused on the short-term AI struggles and is ignoring other significant positive developments. They see powerful growth drivers emerging from the ongoing success of the Foundry business, particularly landing those large multi-year contracts like the one with Microsoft, and also the immense, potentially underestimated long-term potential of the AI PC market, where Intel has a dominant position.
So, focusing on Foundry and AI PCs as the hidden value.
Exactly. Online comments from optimistic investors often praise Gaudi 3's clear cost and efficiency advantages over Nvidia's H100, saying things like, it beats H100 on inference per dollar, huge potential once the software catches up. They see the current issues as temporary roadblocks, not permanent failures.
So, bear case, execution failure, bull case, undervalued assets and future potential. Which thesis seems more likely right now?
Assessing the probabilities. Given Intel's highly diversified portfolio, remember, they still have that massive profitable CPU business alongside AI and Foundry, and the undeniable tangible momentum building in their Foundry segment with real customer wins. The bull thesis arguably appears more likely to play out over the longer term. However, and this is a crucial however, this optimism must be heavily tempered by the very real, demonstrated execution risks, particularly around software development and meeting product roadmaps on time. It's a nuanced picture, absolutely not a slam dunk either way, but one with significant potential upside if they get it right.
And the stock price itself, where does it sit relative to that intrinsic value estimate?
Right, bringing it back to the current market. As of our recording date, roughly June 22, 2025, Intel's stock price is trading somewhere around $22 per share. This is clearly materially below that estimated intrinsic value range of $30 to $35 that we discussed earlier, based on DCF models assuming a successful turnaround.
So a potential discount built in.
Exactly. This difference, this gap between the current market price and the estimated intrinsic value, potentially offers a significant margin of safety, as value investors like to call it, for patient, long-term investors who believe in the turnaround story. It suggests that if Intel can successfully execute on its strategic plans over the next few years, there's considerable upside potential that doesn't seem to be fully reflected in the current market price. It boils down to a bet on future execution delivering on today's potential.
Okay, this brings us to the moment of truth, really. After all this analysis of the leadership, the tech, the competition, the financials, can this tech giant really stage a successful comeback in the scorching hot, hyper-competitive AI market? What's their actual battle plan to reclaim their place at the top, or at least become a strong number two?
Intel's AI strategy, which they laid out quite clearly at their Vision 2024 event, is precisely that battle plan, and it centers on a very specific philosophy: building open, scalable, and secure enterprise AI systems.
Why the emphasis on enterprise?
That focus is critical because, as Intel rightly points out, the success rate for actual generative AI deployments within large businesses is currently notoriously low. Some studies suggest it's only around 10%. Companies are pouring millions, sometimes billions, into AI pilot projects, only to see many of them fail to scale or deliver real business value due to complexity, cost, or integration challenges.
So Intel sees an opportunity to be the practical, reliable choice for businesses.
Exactly. Intel aims to solve that deployment problem, making powerful AI more accessible, manageable, and ultimately functional for mainstream businesses, thereby ensuring higher success rates for their customers. It's a strategy focused on enterprise pragmatism as much as raw performance.
What are the key components of this enterprise-focused AI strategy?
It has several key interconnected components. First, obviously, there's the Gaudi 3 accelerator, which launched commercially in Q3 2024. we need to reiterate its core value proposition. According to Intel, 50% better inference performance and 40% better power efficiency than Nvidia's H100, all at roughly half the price, around $15,625 versus $30,678. That cost-performance efficiency advantage is a huge potential selling point for budget-conscious enterprises.
And the software support.
Crucially, it's built to support open-source AI frameworks like PyTorch and popular platforms like Hugging Face right out of the box, making it theoretically accessible to a wider developer base without proprietary lock-in. And, as mentioned, it's already being deployed in systems sold by major partners like IBM, Dell, and Bosch.
Okay, Gaudi 3 is the current weapon. What's next in the arsenal?
Next, looking further out to 2026, is Jaguar Shores. This is their ambitious next-generation rack-scale AI solution. It's planned to utilize advanced silicon photonics technology.
Silicon photonics, what's that?
Think of it as using light instead of electrical signals to transmit data incredibly fast between chips and components within a server rack. It allows for massive bandwidth and lower latency, which is critical for large-scale AI systems. Jaguar Shores is specifically designed to directly compete with Nvidia's high-end Blackwell platforms and whatever comes next. It's also the direct replacement for that previously canceled Vulkan Shores project, showing perhaps a refinement of their long-term vision based on lessons learned.
So, a high-end challenger coming later. What about the software piece of the strategy?
Right. On the vital software side, they launched the Intel Tiber portfolio alongside Gaudi 3 in Q3 2024. This is an absolutely crucial piece of the puzzle, as Tiber is a suite of software tools and services designed specifically to streamline enterprise AI software deployment. The goal is to make it significantly easier for businesses to actually use Intel's AI hardware effectively and integrate it into their existing IT environments. Because, as we've stressed, great hardware without great usable software just doesn't win in AI.
Trying to solve that Gaudi adoption problem.
Correctly. Then, complementing the data center strategy, there's the massive AI PC initiative. Remember that target. 100 million AI PC shipments by 2026, all powered by their Core Ultra processors. This isn't just about winning server sockets. It's about bringing useful AI capabilities directly to the individual user's device, your laptop, creating a potentially vast new market segment that could redefine personal computing and drive huge volumes for Intel.
Spreading the AI bets across data center and client.
Exactly. And finally, underpinning all of this is the rapidly expanding Foundry Services division. They are actively manufacturing advanced chips for external clients, with that landmark, multi-year, potentially $40 billion contract with Microsoft for the 18A process being the prime example. The potential even exists down the road for them to manufacture chips for competitors like Nvidia or AMD, should those companies choose to use Intel's advanced process technology. This positions Intel not just as a chip designer competing with others, but potentially as a critical, neutral manufacturing hub for the entire AI industry, a role that fabless Nvidia simply cannot play.
So how do all these pieces fit together? How do they actually plan to catch up to NVIDIA?
It boils down to a multi-pronged attack, a strategy of asymmetric warfare almost. They plan to compete by one, focusing on cost-effective hardware, leveraging Gaudi 3's lower price point and superior efficiency to appeal to budget-sensitive segments of the market. 2, championing truly open ecosystems, deliberately avoiding the proprietary lock-in associated with NVIDIA's CUD, which strongly appeals to enterprises craving flexibility and choice. 3, targeting diversified markets, simultaneously hitting AI, not just in the data center, but also heavily in PCs and at the network edge.
And leveraging partnerships.
Absolutely. Their strategic partnerships with established enterprise players like Dell, IBM, HPE, and the crucial cloud relationship with Microsoft are absolutely critical to bolstering this ecosystem strategy. They need these partners to help integrate, sell, and support their solutions in the market. And finally, those massive foundry investments are designed to eventually give them a manufacturing cost and technology advantage, positioning Intel not just as another chip designer, but as a vital manufacturing backbone for the entire AI industry.
But the hurdles remain.
The hurdles absolutely remain, and we have to acknowledge them. The software immaturity, starkly highlighted by Gaudi 3's missed targets, is challenge number 1. Past execution issues, like the Vulkan Shores cancellation, raise valid questions about their ability to deliver complex roadmaps on time. These are real challenges they must overcome. Despite this, analysts like Stephen Dickens remain cautiously optimistic, seeing significant underlying value in Intel's undervalued foundry and CPU businesses, and projecting potentially strong AI sales growth kicking in during 2025 as software matures. It's a turnaround story still in progress.
So let's distill this entire complex picture down to the absolute core for our investors listening. After everything we've discussed, what are the undeniable truths? What are the biggest risks they need to keep front of mind? And what crucial things remain genuinely uncertain as we look at this tech giant's future?
Okay, let's get straight to it. The key undeniable truths are these. First, Intel possesses an incredibly diversified portfolio spanning its foundational cash cow CPU business, its ambitious AI efforts, and its rapidly growing, strategically vital foundry services. This diversification provides a relatively robust foundation, a broad base to stand on, unlike some more narrowly focused competitors. That's truth number one.
Diversification is real. What else?
Second, Gaudi 3's impressive price-performance edge, particularly its significant cost-effectiveness and power efficiency compared to Nvidia's H100 benchmark, is an undeniable technical truth. It gives Intel a strong, compelling product value proposition in the AI inference market, provided the software is there. That advantage is real. Third, the significant foundry wins, especially that massive multi-billion-dollar, multi-year contract with Microsoft, are tangible validations of their manufacturing strategy and signal significant long-term potential. These aren't just hopes, they are facts you can point to.
Okay, those are the solid truths. Now, the flip side, the biggest risks.
The key risks are equally stark and absolutely must be weighed carefully by any investor. First and foremost is developing a robust, competitive software ecosystem for their AI hardware. This remains a massive, ongoing undertaking where Intel currently lags significantly behind NVIDIA's mature CUDA platform. This isn't a quick fix. It requires sustained, long-term investment and execution. That's risk number one, and it's huge.
Software, got it. Risk two.
Second, execution delays. These have unfortunately been a recurring pattern for Intel in recent years across various product lines. Any further significant delays in bringing crucial products like Jaguar Shores to market or in maturing the Gaudi software could fatally stifle their progress and allow competitors like Nvidia and AMD to pull even further ahead, making their climb impossibly steep. Execution risk is very high.
Risk three.
Third, the sheer force of Nvidia's continued overwhelming dominance, particularly with upcoming platforms like Blackwell, could simply limit Intel's ability to gain meaningful AI market share, especially at the profitable high end, making it an incredibly difficult uphill battle against a deeply entrenched and highly innovative titan. Competitive risk is intense. Lastly, those geopolitical risks, especially surrounding U.S.-China relations and stability in Taiwan, continue to cast a long shadow, threatening global supply chains and potentially impacting Intel's manufacturing operations and crucial market access in unpredictable ways.
Okay, truths and risks. What about the big unknowns, the key uncertainties investors just have to live with for now?
As for key uncertainties, the ultimate success and market adoption of Jaguar Shores, slated for 2026, remains a major unknown. It's positioned as a critical piece of their long-term AI strategy, a true NVIDIA competitor, but its real-world performance, cost, and customer uptake are still entirely speculative at this point. That's a good question mark.
Will Jaguar Shores deliver? What else?
Another significant uncertainty is Intel's ability to truly scale Gaudi 3 sales effectively. Can they move beyond initial deployments with key partners to achieve widespread, high-volume adoption across the broader enterprise market? Can the software mature quickly enough to unlock that potential? That scaling ability is still unproven. And beyond Intel's direct control, any unforeseen major regulatory changes regarding semiconductor trade policies or export controls could significantly disrupt their global operations and market access in ways that are very difficult to predict today. These are the variables that could swing the outcome significantly.
So, given all the truths, the risks, the uncertainties, where does the edge lie for an individual investor looking at Intel right now?
Your investor edge here, potentially, lies in understanding and weighing this complex balance. Intel's current apparent undervaluation, with that stock price hovering around $22 compared to an estimated intrinsic value potentially in the $30-$35 range, combined with the undeniable, tangible momentum building in their foundry business. This combination could offer asymmetric upside for patient long-term investors who are willing to tolerate the significant risks involved.
Asymmetric upside meaning more potential gain than potential loss.
Potentially, yes, if the turnaround succeeds. The market seems to be pricing in a lot of the negativity already. To truly capitalize on this or decide if the risk is acceptable for you, monitoring their execution very closely is paramount. Watching their upcoming Q2 2025 earnings reports for signs of stabilization or growth, and getting clear updates on Gaudi sales traction and software maturity will be absolutely critical indicators of whether this ambitious comeback story is truly unfolding as planned, or if the risks are starting to materialize. vigilance is key.
We've embarked on an intricate journey today, exploring the complex battleground of a true tech giant striving against formidable odds to redefine its legacy in the white-hot crucible of the AI age. The fundamental question for you, the investor, isn't just if Intel can possibly execute this incredibly ambitious comeback plan.
But perhaps more importantly, how much of that immense future potential versus the very real risks is already baked into its current, seemingly discounted valuation.
Exactly. Are you willing to bet on a titan painstakingly rebuilding its empire brick by brick, often using open source mortar in arguably one of the most competitive technology arenas on the planet?
Consider that delicate, crucial balance between Intel's undeniable history of past dominance and the urgent, absolute necessity for near-flawless future execution against rivals who are firing on all cylinders.
This company's ongoing story isn't just about silicon chips and manufacturing processes. It's a compelling, real-time testament to the relentless, often brutal pursuit of innovation in a world that never ever stops changing. Keep asking the big questions.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.